Pozdravljeni, moje ime je Gregor Kovač, prihajam iz družbe V&D Zlato, vašega zaupanja vrednega trgovca s plemenitimi kovinami. Z veseljem vam predstavljam nov video v seriji videov, ki jih za vas pripravljava skupaj s Torom. Gre v glavnem za prevode zelo zanimivih intervjujev z zanimivimi sogovorniki. Tokrat gre za intervju z izjemno uspešnim traderjem, trgovalcem Garrethom Solowayem. Spremljam ga že kar nekaj let. V vseh teh letih je imel kar nekaj napovedi, ki so se uresničile. Moram reči, da večina njegovih napovedi se je uresničila vsaj kakih 70%. In pogosto so njegove napovedi povsem v nasprotju z nekim splošnim prepričanjem, tako da ga z zanimanjem vedno poslušam. No, in v tem videu boste videli, da napoveduje močan padec delniških trgov in pa, kar je zelo zanimivo, napoveduje kratkoročno tudi padec trga zlata in pa srebra. Po njegovem mnenju bo zlato padlo morda celo do $3,500 za unčo, trenutno se giblje okrog $5,000 za unčo. To bi pomenilo, da iz trenutnih 140,000 za kilogram, da bi cena lahko padla celo na ali pa pod 100,000 tam nekje za kilogram, kar je kar močna napoved. No, ampak on jo tudi argumentira. Za srebro mimogrede napoveduje, da bi lahko padlo nazaj na približno $50 za unčo. No, ampak kar je zanimivo, seveda poudari, da on svojega zlata in srebra, ki ga ima v fizični obliki, ne prodaja. Namreč je zelo bullish, kako bi rekli, optimističen glede razvoja cene teh dveh kovin v prihodnosti, srednje in dolgoročno. Za zlato napoveduje v prihodnjih letih, da bo prišlo vsaj na 7,500 ali pa $10,000 za unčo. In če bo zlato recimo pri $7,500 za unčo, pričakuje, da bo srebro pri $200 do $250 za unčo. Moram reči, da mi je ta scenarij pravzaprav všeč. Če bi prišlo do ene takšne korekcije v naslednjih mesecih, bi to pomenilo, da tisti, ki že imamo nekaj zlata in srebra, da ga lahko še nekaj kupimo po nižjih cenah. Tisti, ki ga pa nič še nimajo, pa seveda lahko vstopijo na ta trg pri bistveno bolj ugodnih cenah, kot so trenutno. Da ne govorim o naših mesečnih varčevalcih, ki bi s tem opravili nekaj zelo ugodnih nakupov. No, ampak moram pa reči, da je v tem trenutku zelo veliko strokovnjakov, ki pa napovedujejo drugače in pravijo, da je $5,000 zdaj dno, da zlato pod to bistveno ne bo več šlo in da so odprte možnosti samo še za rast. No, ampak poglejte si sami, kaj pravi Garreth Soloway in kako argumentira svoje napovedi. Uživajte.
Part of me almost wants to say this could be even worse than the financial crisis if it ticks over that cliff. I do think by year end, we're now in a recession officially by the numbers. Once the economy starts to slow, it's going to spiral into that recession. Just in 2008, you had oil prices spiking and the credit crisis was beginning. You have the makings of this dual factors exactly like that. Now, I'm not saying it's going to be exactly like that catastrophic event, but ultimately it leads us down a path to tell us what is likely coming. We've dammed up the water, right? To the point where it's being held back by all quantitative easing, all of these maneuvers, the government spending. At some point that dam breaks, the longer it stays in place, the more water it holds back and the bigger the ultimate fiasco is. When it does happen, it is going to be nasty.
What is the biggest risk you see in the market right now?
I know people aren't going to want to hear this, but I think in fear and panic, we are going to see a move down here to $3,500 per ounce by year end. Now, at that point, I'm buying more physical.
You're saying that you see gold dropping to 3,500 by the end of 2026.
Yes.
That is quite the contrarian call there, Gareth. What would push it down to 3,500?
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori, and this is The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. And some strategists are warning that the current market environment is beginning to resemble the early stages of the 2008 financial crisis. Bank of America strategist Michael Hartnett says that the combination of surging oil prices and growing concerns around private credit exposure is starting to look eerily similar to the period leading up to the global financial crisis. In 2007 and 2008, oil doubled from around $70 a barrel to $140 just as the first tremors from the subprime crisis began to ripple through the financial system. Today, oil prices have been surging following the outbreak of war with Iran, raising new concerns about inflation, tightening financial conditions, and pressure on corporate earnings. Those energy-driven inflation risks are already beginning to influence policymakers. European Central Bank and Governing Council member Peter Casimir warned earlier this week that the conflict in the Middle East could push the ECB to raise interest rates sooner than previously expected. And the conflict with Iran is injecting a lot of uncertainty regarding the impact, consequences, and duration of the war. Meanwhile, fresh economic data suggests that the U.S. economy may already have been losing momentum even before the current geopolitical escalation. The latest revision to fourth quarter GDP shows that the economy grew at an annualized pace of just 0.7%, down from the initial estimate of 1.4%, and sharply slower than the 4.4% growth recorded in the previous quarter. The labor market is also showing signs of strain. The latest jobs report showed that the U.S. economy lost 92,000 jobs in February, far below expectations for job gains, and the unemployment rate ticked up to 4.4%. Revisions also cut around 69,000 jobs from the prior 2 months, indicating that the labor market may be weaker than previously believed. So, where are the markets headed from here? Are we moving towards inflation, stagflation, or could there be a surprise to the upside? And what are the trades that investors should be watching now? Well, joining me now with his perspective is Garreth Soloway, Chief Market Strategist at Verified Investing. Garreth is a widely followed technical analyst that has over 2 decades of experience as a trader and a chartist. And he's known for his bold and timely calls, like his big contrarian call in late 2021 that Bitcoin, then at 69,000, would fall to 20,000 in 2022. He also correctly forecast gold's breakout when it was stuck around 1,900 in 2023. Garreth combines technical chart analysis with macro fundamentals to tell investors where he sees the opportunities and the risks. Garreth, good to have you back with us.
Oh, so great to be here, Michelle. Thank you for having me.
All right, Garreth, I'm going to start off very nicely, and I'm going to let you take a victory lap, because when you joined me late last year, you made a very clear call that oil was shaping up to be one of the biggest trades going into 2026. We spoke on December 24th of 2025, and you talked about both geopolitical tensions and capital rotation into energy, making oil your top call. Here's what you said. What is your top trade for 2026?
My top first half of 2026 is going to be oil. I think oil's about to break out here to the upside. Keep in mind, if you talk inflation adjusted, like we're talking about with silver, think about what inflation adjusted oil is. I mean, that's incredibly cheap. Ultimately, this table is set, I think, for a 50% up move in oil in the first half of 2026.
All right, you called it. Well, we haven't had quite 50%, but almost there. And a number of factors. Capital rotation was the one you cited, geopolitical risks as well. So looking forward from here, what does the chart tell you about oil?
Yeah, so this is really an interesting situation, right? We have the conflict with Iran going on. The Straits of Hormuz are closed. We came into this weekend, obviously, with oil kind of pushing back to about $100 per barrel. Now, my guess is people are having kind of a flashback to last week when we went into the weekend and we didn't have that kind of risk premium in oil yet. And Sunday night into Monday, it spiked to $120 per barrel. Now, my guess is we're nearing a topping point in oil. I actually think at this point, you dump it, you move back into other asset classes, although it's tricky to find them, but we'll go over them. I think oil, again, within 3 months is back below $70 a barrel.
Okay, so you're getting out of your oil trade right now?
Yes, yes, absolutely. So this has been a massive move. It's now become the hysteria trade, the excitement trade, the psychological, emotional trade, which is where I get my cues to say, okay, I was in it calling in the 60s when we were breaking out. That was when everyone else hated it. People were questioning and saying Garrett's nuts about this call, like so many others. Now we're at the point where everyone is saying, oh, oil could go to $200 to $250 a barrel. That's where I start to say, pull the ripcord. Maybe it goes there. Most likely it doesn't because demand destruction is going to play the biggest role. And eventually we're going to figure out a way to open the Straits of Hormuz.
All right. So, as usual, being the contrarian, when people are buying oil, you're looking the other way. So, let's talk about that because, yes, if the Strait of Hormuz stabilizes, that changes the landscape. Production ramps up. There have been efforts to have that happen. But you're saying $70 oil by the next 3 months. That sounds like you're pretty optimistic that this conflict wraps up by then.
Yeah, I am. And I think you have to look at the other factors. So you mentioned that not only do I combine technical analysis, but then I add in that macro perspective. And what we have to recognize is we have midterm elections coming very quickly. The longer oil stays up at 80, 90, $100 a barrel, it's going to take longer for that inflation to work through the system. And you have a president who's very aware of this, and he's going to make sure that within a short amount of time, there is some sort of opening of the straits to let oil flow again. Otherwise, inflation is going to go back to 5, 6, 7% by the November elections, and it's going to make it almost impossible for the Republicans to do even a little bit well.
Right. And there's also the issue of supply. The United States is energy independent.
Right.
And even though the Biden administration drained the Strategic Petroleum Reserve for political gain, there's still, from my understanding, at least 4 years worth of oil in the Strategic Petroleum Reserve. And it sounds like the Trump administration is going to start releasing some of that starting next week. So you're out of oil, but let's talk about the oil stocks because Oxy Petroleum was one of your big calls going into 2026. I believe it's up around 36% year to date. And please feel free to share your charts at any time. So what's your call on Oxy? That was another one of your big buys going into 2026. Where do you stand on that?
Yeah, so same sort of thing. And you can see my chart here on Oxy. Here was the trend line we were watching going into the beginning of the year. We were trading down in this lower range. We've come up, we've broken out. And so I would be looking for Oxy to start to pull back here. It's had an incredible move from about $38 to now almost $60. And I do think, again, with oil pulling back, you're most likely going to see our back and fill back to about the $47 level. So again, just on a technical basis, there's a lot of support here around 48. And here's a gap fill at 47. Price should come back in there. Once it gets there, I'll start eyeing it again, but I'll reevaluate the macro areas to decide if it's time to rebuy on Occidental Petroleum.
And does that apply for other oil producers as well?
It does. If you
Investing?
take a look here at like Chevron is exceedingly expensive now on the charts. Look at this move up here. It almost looks like an AI stock at this point. These type of moves, these parabolic moves historically, while they can stay elevated, they eventually do come in. And remember, the old adage is the best solution for high oil prices is high oil prices because oil staying up, it destroys demand. People start driving less. It creates an economic slowdown, which then naturally brings in the price of oil. So if the president's not able to do it by opening the Straits of Hormuz, eventually you're going to have people doing it by consuming less in their motor vehicles and in other ways.
Right. And of course, ramping up production, higher oil prices incentivizes oil producers to ramp up production even more. That's usually how that works. Look, it's very hard to make any kind of calls because we don't really know if this conflict gets contained. It could escalate further. It could also be over by the timeline that the Trump administration has suggested that it would be. How do you factor that uncertainty into this call particularly?
Yeah, so to me, it's a probability-based call, and I think it's important for everyone to understand is I don't have a crystal ball. I'm wrong on some calls. I'm just right on more calls, right? And so the idea is that I look at the data, the chart data combined with the macro and understanding what's going on in the president's mind from a political standpoint, and that's how I come up with these ultimate calls based on probability. It's kind of like being in a casino. If you're told that you have a 70% chance of winning at this game, you're going to play it every single time because you know 7 out of 10 times you're going to win. And so that's what we're doing right here. We're looking at the charts. We're saying when this occurs, the odds favor a drawdown. Then we look at the macro and we say, okay, that reinforces that, bringing those probabilities to those levels where it makes it a solid call to talk about.
All right, so let's look at the macro because obviously oil feeds into inflation. What are your calls on inflation?
Yeah, so in the near term, inflation is going to go up. And unfortunately, this is going to hurt a lot of middle income and lower income individuals who have already been crushed by inflation over the last 5+ years, right? And so we're looking at a scenario where you have the middle income already starting to cut back. This used to be a market, if you look back a couple years ago, where the low income, they were the ones cutting back, but the consumers in the middle income and the higher income were still spending. Now the middle income's falling to the wayside and the economy is just running on the higher income, which is likely based mostly off the stock market returns. Now that we're starting to see a rounded top on the S&P and a move lower, it's very possible that the consumer on the high end will start slowing down as well. That's going to speed our descent into a recession likely later this year. I heard you mention the GDP numbers. Those were surprisingly weak after a 1.5% reading to be cut to 0.7. That's a warning sign. You throw in additional inflation and that dreaded word of stagflation pops up very clearly.
So you're seeing stagflation as in higher inflation and reduced economic growth, negative economic growth by the second half of 2026?
Yes, I think that will be the case. And I do think by year end, we're now in a recession officially by the numbers. And so, again, you look at all the factors, right? I mean, we have the private credit markets that are crumbling at this point. I mean, I think that quote in the beginning from Bank of America said it perfectly. Just in '08, you had oil prices spiking and the credit crisis was beginning. You have the makings of this dual factors exactly like that. Now, I'm not saying it's going to be exactly like that catastrophic event, but ultimately it leads us down a path to tell us what is likely coming. You throw in defaults on credit cards and auto loans being at major highs at this point. There's a lot of signals that are now telling us that the consumer is getting crushed. And once the economy starts to slow, it's going to spiral into that recession.
All right, look, let's focus on the weak GDP revision here. It doesn't necessarily mean, though, that the economy is headed for trouble right away. I mean, there's several reasons why growth could still hold up. I mean, you could also say that the numbers were a little on the upside to begin with. You can still have the government coming in, or rather the Fed coming in and cutting rates, stimulating some growth there. We know President Trump is certainly calling on the Fed to do so. He posted on Truth Social earlier this week that Powell should cut rates immediately, even before next week's Federal Reserve meeting. He posted, "Where is Federal Reserve Chairman Jerome Too Late Powell today? He should be dropping rates immediately, not waiting for the next meeting."
Right.
President Donald J. Trump. Whether the executive branch should be interfering so directly with the Fed is a whole other conversation, something that the president has certainly shown that he's more than willing to do. But what do you expect from the Fed in this environment? Keeping in mind we do have Powell, I believe, until June, where if Kevin Warsh is confirmed, he steps in, although arguably he seems to be even more hawkish. But what is your call on the Fed here?
Yeah, so what I'm seeing is, and right now the Fed Watch tool, it's pricing in one rate cut in September, I believe, of this year, and then no rate cuts after that until I believe a year later. I think they're going to come faster, and I'll tell you why, is because after we get through this period of stagflation, which is higher inflation, and as the economy slows down more and more, eventually inflation is going to be tamed because there's going to be a lack of buyers of goods, right? The consumer, as it stalls out more and more, is going to mean less competition for goods, and it's going to start to bring in prices. So eventually, when the economy weakens enough, we go from stagflation to just a plain old recession and maybe even deflation, which will then enable the Fed to start cutting rates. The question is, and we saw this in 08, 09, right? It's not like the Fed can just cut rates and save the day. Once this snowball starts down the mountain, it's not exactly an easy thing to derail and get back on the right track. And so again, you're looking at an even different scenario in terms of government debt, now approaching 39 trillion. The spending is at even new all-time highs. In fact, at how fast we're spending. A lot of this now on the military conflict with Iran as well. And so there's so many moving parts here that are going to make it almost impossible. In my opinion, the Fed's not going to be able to save the day with just a rate cut or two. It's going to take time. It's going to take a lot of damage to the economy to get back on the right foot.
So what does that mean for your broader outlook for the markets, for the S&P 500?
Yeah, so I would be surprised, and my base case is a 20% drawdown. I think we're down about 5% now just since the early February period. I do think once oil prices come down, and I do think they will, you'll see an immediate buy the dip mentality reaction in the market, sending the market higher for a few days. I don't think we take out the all-time highs, and in fact, I think eventually we roll over, and we'll see the S&P in around the 5,600 mark by year end.
So 20% by the end of the year?
Yep. Yep.
You're
And keep in
seeing
mind, we're already down from all-time highs. We were down just from February, about 5% now, but about 7% from all-time highs at this point. So we're already kind of marching in that direction. I just don't think it's going to be a straight line. I think there's still lots of buy the dip mentality amongst retail investors, but just be prepared that over the course of the year, I think we make lower lows and lower highs.
Okay. Our viewers will say, it's bearish, Soloway. You're always bearish. You're always calling for an equity market correction.
Well, you could
Why?
say, listen, you could say that, but in all fairness, in April of 2025, I was buying with all my hands on the market, right? So it's all a matter of where the charts are. And if we take a look at my chart here, take a look at this S&P. I just simply look at the charts, right? And so here we have on the S&P, we have this parallel, right? And the parallel has literally told us every time the market bottoms, it's at the low end of this parallel. And then every time it tops, it's at the high end. And so when I came into this year and you and I talked late December, I was bearish on the markets because we were basically right up into that parallel line, which told me the markets were likely topping. And since then, we've rolled over, as we can see right here. And so again, just following the charts lets me know when we collapse down here to this 55, 5,600 level, I'll say, okay, well, listen, I'm not reinventing the wheel here. We saw this was a buy here during the liberation sell-off in 2025. It was a high during the it was a buy during the bear market levels, and it was a buy during the COVID level as well. And so it's just a matter of where the markets are. Again, of course, people will say that because I understand they're long markets. They want the markets to go up, but I got to call it like the charts are telling me.
All right, let's talk about private credit. You told me that that is one of the biggest risks that you see in the market right now. Well, let me ask you, what is the biggest risk you see in the market right now?
So I don't actually think it's oil. I think oil is just one more nail in the coffin of the market. I think it's a factor that's going to speed things up, the eventual, obviously, decline of the markets and recession in the economy. But really, again, you look at this private credit crisis that's starting to unfold where you have BlackRock, Morgan Stanley, Cliffwater. These are all places that are limiting withdrawals because they're essentially getting bank runs on their funds. People are trying to withdraw so much money. This all stems, interestingly enough, from the AI trade. So many of these software companies took out massive loans, and now people are worried they're not going to be able to pay them back. Too much money has been borrowed, not enough return is expected, and that's causing essentially a run on these funds. And this is exactly like you mentioned at the beginning, how things started in 08, 09, right? We saw this beginning to unravel. Remember, the private credit markets are $2 trillion worth. So this is not a small deal. This is massive. This is where Oracle goes to get its money. This is where all of these companies go to get their money that they've been borrowing to build out data centers, which in all fairness, we don't even know where the energy is going to come to power these things, right? So it's really another factor that is going to be majorly influential in likely the drawdown in the market this year.
Well, the private credit market actually exploded after the 2008 financial crisis when tighter regulations pushed banks away from riskier lending. Now, as you mentioned, we've seen several large funds capping investor withdrawals after redemption requests surged. Funds managed by Morgan Stanley, Cliffwater, both limiting redemptions after investors try to pull far more money than the funds were structured to provide. Many worry, though, that this could have a contagion effect, that this could spill into the banking system because some of the major banks provide financing to many of these funds through loans secured to their portfolios by something known as back leverage. So while they're not going directly to the banks are lending to the funds are lending to these riskier initiatives, shall we say. JP Morgan began restricting some lending to private credit funds after marking down the value of certain loans. Again, if these assets fall further, banks may be willing to then lend less, tightening liquidity across the sector. And the banks themselves also have exposure here. Correct me if I'm wrong. I think some estimates say that they've extended roughly $300 billion in financing to private credit funds. I will remind you that Jamie Dimon warned last year that more, quote, cockroaches could emerge in the once booming world of private credit. And as you mentioned, this all started with Blue Owl. We're starting to see restricted withdrawals, which forces people to then maybe pull money out of other areas, liquidity issues. Paint the picture of how a private credit situation could, in fact, unravel into something much bigger, especially when you combine it with the external factors like higher oil prices, but help our viewers understand we'll call it the worst case scenario here.
Yeah, and so really it's all connected, right? And so you have banks like Deutsche Bank that came out this week and said basically they have $30 billion at risk in this private credit blowup. Western Alliance Bancorp just came out and said they're going to take a $126 million write down. And to me, this again, like you're saying, is something that travels through. So higher oil prices put more stress on consumers. And there's been the models that have already been created by these AI firms when they were getting these loans, right? When you apply for a bank loan or a private credit loan, you're basically saying, okay, well, we're going to make X amount of money in this amount of time, and this is how we're going to pay it back. Well, all of a sudden, the metrics are changing at this point where you have a consumer that's going to be more and more stressed. More and more money has been pumped into this loan, essentially, or these loans for these data centers that really at this point, we're not even sure when the return is going to come, but it was stated in these loans that they would get the return within a year or two. And that's looking less and less likely. And so essentially, the weaker the economy, the more stress on these loans there will be. And then oil prices are just adding to that because of the stress on the consumer that then travels through the whole profit scenario for all of these companies, right? So it really is all interconnected. And we even look at things like commercial real estate. I mean, commercial real estate has been in the toilet for a long time, and that's not getting better anytime soon. We see real estate starting to come down very, very hard in many parts of the country. And I do worry that the contagion starts maybe in the private credit markets, but then spreads all over. And one thing you said that was interesting was that you talked about how these banks were doing these kind of backsided loans, even though they're not directly. To me, that screams derivatives, which is one of the main things that got the banks in trouble in 08, 09.
All right, so let's bring it to 2008, and let's talk about the parallels that the strategist Michael Hartnett at Bank of America is saying that we're seeing, and he is, as we mentioned, says that the current market environment is starting to look uncomfortably like the 2008 financial crisis. He brings up oil prices, two major warning signs. In the run-up to the financial crisis, oil doubled from about $70 in 2007 to nearly $140 by mid-2008. Today, oil prices, of course, have surged again, up more than 60% this year. And Hartnett highlights the stress in private credit markets, as we just discussed, and concerns amounting about banks' exposure to private credit funds. He is also mentioning that we could see a situation where European banks start to raise rates because of inflation concerns, which puts pressure on the global system. How likely is it that this does become something similar to 2008 financial crisis? What do you make of his metaphor or analogy here?
Yeah, it's such a hard thing to know if it's going to be, equal to. Now, again, if you ask me in the next 10 years, will we face something equal? I would say even worse within the next 10 years. But again, whether or not this is the straw that breaks the camel's back is hard to know. Now, what we do know is that you're right about rates, right? If we look at my chart here on the 10-year yield, the 10-year yield has spiked dramatically just since oil prices went up. Now, there's two folds here. Number one is that this is telling us inflation expectations are going up, aka rates have to go up in response to inflation, right? Number two, if you look at the 30-year yield, the 30-year yield is spiking to near 52-week highs because the U.S. deficit is exploding so quickly now that people that are buying the U.S. debt are saying we need a higher interest rate to take these treasuries on at a 30-year pace, right? And so, again, all of this is kind of pointing to a system that you could arguably say is it a worse situation than '08 or '09, right? I mean, where was the U.S. debt back then? It was a lot lower, right? Where was the U.S. consumer in '07? They were doing a lot better versus where we are today, right? We're in a situation where auto loans are at highs for defaults. Credit cards are at the highs for defaults. A lot of this is way different in terms of worse than things were in '07. And so part of me almost wants to say this could be even worse than the financial crisis if it ticks over that cliff. And that's the big thing. Can the Fed pull the rabbit out of the hat? Can they suddenly come in with massive liquidity to backstop this situation? If they do, okay, they postpone it. They don't cancel it. There's no getting out of the way of this train wreck.
This particular train wreck, I mean, one could argue that the bigger train wreck is debasement and devaluation and the big print, which brings us to gold. Let's talk about gold because gold has rallied very strongly over the past year, but it sort of stalled despite the geopolitical tensions. Usually gold moves on these kind of conflict, geopolitical tensions. It is a safe haven. But gold has actually pulled back a little bit or stayed mostly flat. What are the charts telling you about gold right now?
Yeah, and this is really interesting because, like you mentioned, gold is usually a safe haven asset. In other words, it should have been roaring the last 2 weeks with this conflict with Iran, and instead, it's actually been weak. If we turn to the charts here, take a look at this. So I want to draw my attention on the charts to this period going into the final run up on gold. This, just like silver, was where momentum and emotion took over. That's what had to be wiped out right there with the drop back to 4,400. Since then, what we've created is a bear flag situation. Now, I want to be crystal clear, and I talked about this with Michelle ahead of time, is that I have not sold 1 ounce of my physical gold or silver. But on a swing trade basis, does gold in the near term say it's going lower? Yes, it does. Not only is this pattern bearish, but then we broke here. This is another bear flag, and you can see us starting to roll over. So short term, I'm looking over the next month or so, we should reattack the 44 to 4,300 level. And I know people aren't going to want to hear this, but I think in fear and panic, we are going to see a move down here to $3,500 per ounce by year end. Now, at that point, I'm buying more physical. I'm not buying physical till then. I've got enough. If it gets down to 3,500, I will buy physical gold at that point.
Preden nadaljujemo, dovolite, da vas na kratko zmotim. Vsebine, ki jih pripravljamo na našem YouTube kanalu, so za vas brezplačne. Če vam je všeč, kar gledate, imam eno prošnjo za vas, dajte klikniti tisti všeček, like pod videom, in če so vam všeč naše vsebine, se naročite na naš kanal, spodaj kliknete na naroči se ali subscribe ali nekaj takšnega piše, pa označite tisti zvonček, da boste obveščeni, ko bomo naložili naslednji video. S tem boste namreč pomagali, da bo še več ljudi izvedelo za te vsebine in seveda ne pozabite deliti tega videa s svojimi prijatelji, znanci in sorodniki. Hvala vam, zdaj pa nazaj na video.
You're saying that you see gold dropping to 3,500 by the end of 2026.
Yes.
That is quite the contrarian call there, Gareth. Look, okay, why? What would push it down to 3,500?
Yeah, so this is where it starts to be understood that the run-up in gold was a classic diversify against fiat currencies money until we got in that last move up. That's when emotional investors played the FOMO game. They just ran in because it was the easy trade. We saw this with silver. Those buyers that bought for the wrong reasons, the get rich quick reasons, they need to be washed out. And as fear envelops the whole system, just like it did with COVID, when we saw COVID, remember, COVID hit March 2020, we saw gold actually dump out. That's what's going to happen here on gold. You're going to see a flush out of the weak hands. It's going to dump out to about 3,500. Then it goes back to a safe haven trade and an offset for fiat currencies. And I think you start climbing back to all-time highs within another year or two.
All right, let me push back here. A couple of things have been very different since COVID, and the big one has been central banks.
It's true.
Because central banks have been buying gold at record levels. That was not the trend in 2020. That trend really kicked into earnest around 2022, one of the most aggressive buying streaks on record. As we know, countries around the world now have more gold than they have dollar-denominated assets. That sovereign demand doesn't change because retail investors are selling. That sovereign demand, that central bank demand continues. We're also seeing de-dollarization. That macro trend is still there. Countries exploring trading arrangements outside the dollar, building alternative payment systems, in some cases settling trade in local currencies like the digital yuan with gold as that guarantee, that neutral reserve layer. One could say that this conflict with Iran could make people question holding the dollar even more. It could push lack of trust in the US even higher. It could create an even bigger demand amongst other countries for that neutral reserve asset for gold. We've just talked about fiscal policy. If this crisis happens with private credit, or even just the situation as it is, the United States is running historically large deficits, almost $39 trillion in debt. The war itself is going to push for more spending. It already has. War is always inflationary, so it's going to create more spending, more debasement, more devaluation. That's where gold comes in, where we see that. There are just so many factors here. Also keeping in mind that previous cycles, certainly in 2020, gold largely driven by Western investors and ETFs. Today, the demand is shifting towards emerging markets. There's a demand for taking physical delivery. We're seeing that trend increase, the shift towards central banks that I just mentioned. So I don't see how the macro fundamentals change because retail investors give up on a momentum trade.
Right. And what everything you're saying is dead on, and I agree with it. That's your macro view, right? And that's my macro view as well. That's why I still hold my physical metals. So if you ask me in 5 years, is gold higher than it is now? Absolutely. It's at all-time highs, maybe even $10,000 an ounce. But the idea here is that what we see investors in terms of their behavior is that if the stock market dumps, they panic, they get margin calls, they dump gold, right? You can see that all across past history. And that's what we're looking at here, is a scenario where you see more of a deleveraging event that involves gold and silver being caught up in it. That ultimately takes it down in the short term, meaning by year end. Then it starts to regain the whole bigger trade narrative, which you mentioned beautifully, that I totally agree in. So again, it's the difference here between looking at the long term or the very short term, which to me is the next 7 or 8 months, right?
Okay, so you're saying in your scenario where there's a sell-off, everything goes down, including gold, because people have to liquidate positions. Is
Yes.
that your argument?
Yes, fear is the most pervasive trigger for everything.
But is it
And
fair?
once you
Because
see that
essentially-
spike, you will see that gold sell off. And again, just drawing back to the same thing, because you mentioned all the central bank buying. I agree with all of that. But again, in the short term, fear again will rule the day and essentially create a selling and ultimate buying opportunity in gold.
But fear is what drives people into gold. I understand that they may be leveraged, that they may be forced to liquidate positions as everything else goes down. But fear drives people into gold.
So it does after the dust settles, right? And so again, I would just harken back to past periods where we saw gold going up, and then something occurs in the bigger macro picture in the economy, like just like we saw during the COVID period of the 2020. But you can go back in history and look, when you see panic actually hit, the initial response is sell everything, ask questions later. And then once people start asking questions, they start to say, okay, wait, now let me see. I won't buy stocks, but let me at least get my money back in gold. And I think that's what's going to happen here. And for those of us like me that love gold long term, like you, it's going to be a fantastic buying opportunity.
A fantastic buying opportunity. I'll take the positive spin there, Gareth. But again, I feel like this market and this timing could be different. You may be right. You may be right. You have been right in the past. But we also have the whole debasement trade that we touched on. And you have institutions buying gold, which they hadn't traditionally done so, right? We had Morgan Stanley, for example, recommending last year that people should go into a 60-20-20 portfolio, 20% allocated to gold. We had other big banks making similar calls. I would think that those hands are likely to be stronger, less weaker hands when it comes to any kind of market jitters.
I agree with that. I do think that, again, institutions will likely look to accumulate on weakness, but I still think even during fear and panic, while they may not be initial, buyers, they will at least stay on the sideline. So when fear and panic happens, even institutional money steps back from the market, right? And I would just point this out. You were talking about institutional involvement, adoption, buying gold, etc. Those were the same type of arguments that I heard on Bitcoin when it was this year or in 2025 in October when we were at 127,000. I heard, well, yeah, but institutions are buying, they're adopting it and all this. And then now where's Bitcoin, right? And so I think the important thing, and by the way, Bitcoin is different than gold. I get it.
I was just going to say, I can already tell the viewer comments right now. How dare he even put gold and Bitcoin in the same sentence? How can he even compare the two? I know our viewers. And
my only thing is human psychology. And so I study human psychology, which has helped me trade so well and make these type of calls. And human psychology, again, the same arguments are made. In fact, when silver was at $120 per ounce, and I said, guys, it's going to dump out here, be careful, I heard, well, this time is different. No, it's not. All of the same things, and then it dumps back to the $80, $70 level. That's human psychology. And while you can utilize that to make trades in the short term, the longer term macro, which you've eloquently said, that will be the longer term play.
What's the trigger for this fear and panic then?
I think, again, it's a combination of a slowing economy that speeds towards recession, inflation. And think about this, the inflation numbers that we saw just about a few weeks ago, we saw that PPI data number that even before oil popped was very, very hot. I think inflation continues to uptick. But I think, again, the key is going to be this corporate profit slide and ultimately the pullback of this AI spend. And I think we haven't even touched on that, but we hear Microsoft spending $200 billion, Amazon $180 billion, Meta $180 billion, so much money. Think about that money going into the economy, and the best we could do in the fourth quarter was 0.7% GDP growth. If you took that out, we're probably already in a recession in the U.S. economy. And so I think people have to understand that. Another caveat that scares the you-know-what out of me in the short term is that AI is starting to take people's jobs. Block laid off 50% of its workforce, said, we're getting rid of them. We're going to let AI do it. We heard Atlassian just yesterday saying they're going to lay off 2,000 or 3,000 employees, doing the same thing, going to AI. You're going to have this mass layoff over the next 5 years or so. And these people, unfortunately, it's going to be very hard to get jobs. The AIs are going to be doing this, and they're going to start taking more and more jobs. And you're going to say, okay, well, isn't AI good for the economy? In the long run, it's probably amazing. In the short run, you're going to have mass unemployment, which is then going to trigger lack of consumer spending and more stress on the system, which eventually will bring on that recession.
All right, I do want to point out that with regards to the GDP numbers, there is some distortion there because we did have that 43-day government shutdown, so that could have distorted the data a little bit. I'm not necessarily saying that derails your thesis here, but that is a point to mention. But what would derail your thesis? What could make things go the complete opposite way? Or at least not crash and sort of stay as we are, continuing to kick the can down the road, as has been the case for the longest time.
Yeah, and I think that's the key, right? Is that there's no doubt that there are levers that can be pulled to kick the can down the road. I don't think there's ever a way to get away from the amount of debt that we've built up as a country, as a world, the situations with fiat currencies and the distrust in the system. But ultimately, what I do think is that if you were to get rid of all tariffs and you were to bring down inflation and start actually getting inflation below 2%, you would give more confidence to the consumer. The consumer right now is still reeling from all the years of high inflation, and now inflation never even got back to 2%. It's starting to spike back up. You have to get confidence back, the consumer back in full. You have to figure out ways to fix the system, get the government debt under control, start talking about a balanced budget. Again, would that trigger a recession alone if the government couldn't spend all the money? It probably would. But there are steps that could be taken inclusive of this if the Fed were to start kicking in another quantitative easing scenario, QE. Again, like I said, and you know this, Michelle, is like these quantitative easings, they're just kicking the cans down the road. It's basically keeping a patient alive by injecting drugs into them where they would be dead if it wasn't for the drugs.
Right. And yet it works, at
Yeah.
least in terms of prolonging the
Prolonging.
patient's life. So if we do have QE, you're going to get debasement for sure, devaluation for sure. And a lot of people then run into the equity markets as a hedge against inflation.
You're
And they
right.
also run into gold. So
Yeah.
that's usually the playbook, is that there is a crisis. The Fed steps in, prints more. Yes, you're losing purchasing power for sure. But people then still go into these assets in order to protect against that.
And you're 100% right. And I think that's really the case here, is that there will be attempts to stave off a type of epic collapse. Now, I don't think the 20% drawdown that I'm calling for this year that's almost your run of the mill. Last year we had about a 25% drawdown due to the tariffs, right? So it's almost like that's almost semi-normal. What we're talking about here is the bigger collapse a la 2007, 2008, 2009, the 1999, 2000.com collapse, where we literally see 50% drawdowns in the equity markets. And that's if they don't pull these levers. My biggest fear here is that if you look at the business cycles, it's like a gentle wave coming in and a gentle wave coming out. That's the way normal business cycles are supposed to work. What we've done is we've dammed up the water, right, to the point where it's being held back by all quantitative easing, all of these maneuvers the government's spending. At some point, that dam breaks. The longer it stays in place, the more water it holds back, and the bigger the ultimate fiasco is. And so, again, whether it happens in the next year or two or in 5 years, I honestly don't know about that. But when it does happen, it is going to be nasty.
All right. So just to recap, gold of 3,500 by the end of 2026. That is your call. Where do you see gold, let's say, then in 2 years' time?
I think gold within 2 to 3 years is north of 7,500, likely within 5 years to 10K. And again, the same reasons that you stated, I 100% agree with on those, in terms of the debasement situation, de-dollarization, central banks continuing to try to diversify away from US dollars. There just has to be this flush out, or likely will be this flush out first. Get rid of the weak hands, let the emotion get out of the gold market, and then let it start a healthy climb to the upside like it was before this last surge up.
I mean, look, you could also argue that if this war against Iran goes well, that creates new faith in the dollar, and not necessarily in a positive sense of faith, but fear-induced faith. That if the United States does again reassert its global superpower status, shows why it got the global reserve currency status in the first place, starts to control the flow of oil and makes sure that oil is priced in dollars, because oil has started to be priced in other currencies. Used to be that up until 2018, 95% of the world's oil was paid for in dollars. Last year, 20% of oil sales were done in non-dollars. If this war works out well, as the Trump administration would like it to, you could say that, the Trump administration manages to reassert the petrodollar system, reassert some kind of dollar dominance, and that would be a negative for gold, at least in the short run.
Yeah, and I do think that's a possibility. We'll have to see how this all pans out. I don't think it changes the long-term trajectory, but you're right. In the short term, that could be an added push to gold to the downside. That could be. I think longer term, even what's going on with Iran is making more and more countries aware of how much power the U.S. yields with that reserve currency, and it will ultimately make central banks continue to buy, even if in the near term, like we're talking about, we head to $3,500 per ounce.
All right. Again, we like to provide our viewers with a range of perspectives and viewpoints. I can already see what the comments are going to be like. Sure, Gareth. Let's talk about silver. You were correct. You did see that silver was going to trace back quite significantly. However, you thought that silver was going to hit $50 by Q1 of 2026. It hasn't done that. I think we actually hit a new all-time high in the beginning of 2026, and then I believe the lowest we pulled it back down to was 70. What's your outlook on silver?
Yeah, so based on the charts, and especially if gold is going to 3,500, silver should still pull back to about $50 a barrel. If we take a look at my silver chart here, we can see that, again, we're now stuck in what we would refer to as a bear flag formation. Bear flags where you have a big drawdown, and then you go sideways like this, and that generally results in a down move. And you can see it right here, sideways chop. And then ultimately, we're even starting now to roll over. So while I don't think by the end, I mean, literally in 2 weeks, we'd have to be at 50. So I don't think that's going to happen within my stated time frame. The last time we talked, I do think it does happen this year. I will stick to my $50 call on silver. And again, it's not going to be a popular statement, but same thing here. This is really what you look for, the retrace here. If we go to the zoomed out chart, we get down to about $50. We retest the 1980 high and the 2011 high. And in technical analysis, I'll just show this real quick lesson on TA, is that when you have a chart that comes up, you break down, you go up, you break down, and you finally break out, there's a tendency for price to want to go retest that line before it makes its next big move up. And that's essentially what we would expect to see here in silver. And so again, what's going to be the trigger? Deleveraging, my guess, kind of the same thing as we've talked about with gold, is that you'll see that pullback. And of course, you'll see the comments, this time is different, the supply, the paper supply versus physical. I get all that. And that makes sense to me in the long term, but it doesn't change the near term drawdown scenario where you see a liquidity flush out, a margin flush out, and we see a pullback to $50. So I'm going to stick with that. Just again, maybe give me another quarter on that one.
Okay, I mean, of course, the macro fundamentals for silver are still there. Industrial demand, we're going to have more demand as munitions need to be replenished after this conflict. Silver is essential for defense. Although we've had analysts on the show that would argue because of that military industrial demand, silver has been manipulated to the downside in order to keep those costs down. So different reasons, but maybe that sort of coincides with your analysis of how silver has to go down first. But ultimately, what is your long-term outlook on silver?
Yeah, I think it's going well above $120. And again, just like you mentioned, great factors on gold, the longer term, same thing. The applications of silver. Silver again is a major byproduct of iron and lead mining, right? And ultimately, what we're seeing here is that no one's really mining silver per se to mine silver, at least not right now. It's just that byproduct. And I think ultimately that's one of the best bull cases for silver over the long term, is that, again, that's going to draw out less and less supply with the industrial demand for the industrial complex, essentially missiles, et cetera. And that's going to drive it much, much higher down the line. So I would think $200, if gold hits, let's say 7,500, I would think you're at $200 to $250 on silver within 2 to 3 years.
Okay, yeah, again, a lot of macro factors with silver, including it being added to the critical minerals list by the Trump administration, tensions in Mexico. But I hear your point that short term, and I would like to remind our viewers that you are, in fact, a short-term trader. You're a swing trader. You move in and out of positions. I always force you to give me longer-term outlooks, but you actually could change your mind in a trade 3 times in any given day.
And in all fairness, in silver, when it dumped out from 120 back into 70, I did go long on that scenario for the bounce, and then I got out right away. So I want to be clear on that. But the best thing for us here is to understand that I still hold every ounce of physical gold and silver that I bought over the last 10, 15 years, and I don't plan on selling those anytime soon. I'm going to hold those basically as an insurance policy for the continued debasement of the U.S. currency and fiat currencies overall.
All right. Now, as we mentioned, you are, of course, it's all down to the charts, right? So if you had to pick one chart right now that you think our viewers need to see, whether it's something that gives clarity on the macro front, whether it's something that illustrates a huge opportunity with the most asymmetric upside, what chart would that be?
Yeah, and so I think the most important thing to remember is there's always an opportunity somewhere. So as bearish as I am on, let's say, gold and silver and the S&P, there are opportunities. I really continue to like Bitcoin here in the near term for a spike to 80 to 85,000. If we look at my chart, we had this big drawdown, right? We came into lots of resistance up here. This is where I was able to make that call on Bitcoin topping out back last October. It was simply just connecting a high from the 2017 high, bull market high, to the 2021 bull market high. And then look, we hammered on it and then eventually we collapsed back down. Now we've come into a scenario where we have a green reversal candle. All of these candles are inside of that green. That's the definition of a bullish consolidation pattern. We broke out, we retraced, and now we're moving up. And I'd just like to point out that if you look at over the last 2 weeks, granted it's a small sample size, what's the best performing asset between gold, silver, and the S&P and Bitcoin? It's Bitcoin. Bitcoin is going up right now while the S&P is going down and gold and silver are going down. I think there's a trade here to 80 to 85,000 over the next couple weeks on Bitcoin. Also, I'll just throw in one bonus here. I think, again, looking at something like ConAgra Brands, defensive name, coming right into double bottom, multi-year lows. If we talk about the economy struggling, this is going to be a player that essentially does cheap TV dinners type stuff. This is probably a place you want to look. Great technical support down here at multi-decade lows. That would be another place. It also pays a dividend, so you get that little bonus as well.
Let's focus on Bitcoin for a second here. What are the catalysts? What is the catalyst that would drive Bitcoin higher right now?
Yeah, so I think the catalyst, and this is trickier with Bitcoin, is that number one, I think it got way too oversold. When I was doing my sampling of consumer sentiment or Bitcoin sentiment, it was probably as bad as if we were at the lows of a bear market either in 2022 or 2018, 2019. And so when people get too lopsided, it makes it very easy for you to get these snapbacks intra-cycle. And I want to be clear, Bitcoin goes back to 80 to 85. I think it then turns lower and actually goes below 50,000. But for me, at least, to capture the short-term alpha, this is a nice opportunity. And I think, again, what you're going to see is that you're going to get these institutional players, even including myself. I've been accumulating Bitcoin down here because I don't like the S&P. I can't buy gold and silver up here. Where else am I putting my money? I could have it in dollars, but at Bitcoin at these levels, down basically 50% from their all-time highs, this is a level where I'm willing to put some money to work on Bitcoin. Other institutional money's doing the same thing, and I think that triggers a short covering rally here back to that 80 to 85 level.
Over what period of time?
I'd be surprised if within 2 to 4 weeks we're not back in the 80s on Bitcoin. It could even happen as early as next week. So this is definitely along those shorter term moves I've accumulated. I'm looking for a near term pop here, and then once we get into the 80s, I'll probably be unloading my position.
And because when you see the markets go down 20% and this recession hit, what's your outlook on Bitcoin in that scenario then?
Yeah, so once the fear envelops it, envelops the other equity markets, for instance, in gold and silver, nothing's going to be spared, in my opinion. There's really not going to be many places to hide. I mean, you could look at these dividend payers as kind of low risk. Maybe you break even because you're getting the dividend, but really Bitcoin's headed below 50,000 before it bottoms out. There's a head and shoulders pattern calculation, which is a bearish pattern technical analysis. The max drawdown I see is 35,000. If it gets there, I'm a big buyer. I still am a long-term believer in Bitcoin, but I am, again, just very, very honest about what the charts are selling. We're down in a downtrend. You get a relief rally up, then more downside after that.
Okay, so you're seeing a relief rally up and then more downside for Bitcoin. Big picture Bitcoin outlook? When are we going to hit a new all-time high again?
Yeah, I would kind of rely on past cycles here. I mean, believe it or not, people poo-poo the 4-year cycle, but it's still intact, believe it or not. And this was the highs of 2025, where the 4-year cycle from 2021. And so you have to look at it and say, okay, it took 2022 to pull back. And then really we started to turn up in December of 2022, about a year or so later. And so that's kind of my hope, is that we stick along that same progression where, let's say in October of 2026, we're bottoming out, let's say around 50, 40, 35,000. And then we start to turn up, and then you figure it'll take us about another year or so to make new all-time highs. I do think, again, new all-time highs will come though.
Okay. Two final questions as we wrap up here. This one is a bit of a broader one, Gareth, because everybody's focused on oil and how that impacts the market, but we are starting to see cyber attacks as a weapon deployed by Iran and you could say other nefarious actors. There was an attack against the American medical supply group Stryker. People are not potentially factoring in the risk of cyber attacks sufficiently onto their analysis of things, is some of the estimates that we're hearing. What is your outlook there? I mean, is this a risk that isn't been calculated? Is it something that can be calculated? How do you see cyber warfare as a front in this war impacting the markets?
Yeah,
And
and you're right
granted, you're
about
not a
that.
national security analyst, granted.
That's true. That's true. Just an overall probability analyst. But I think the idea here is that it's probably being underestimated, the risks here. We have seen it in the past. We saw the Delta Airlines scenario. That wasn't necessarily a hack, but it was a CrowdStrike issue that really took down the airlines for many, many weeks there. It was a disaster. I tried to fly during that period and it was just a non-starter. But the idea here is that you can't really attack the US, right, with military might. So how do you go about doing that? And the answer is through cyber warfare. And I do think that's a bigger risk. And I do think the AI age here with supercomputers and AI, that is going to make it a bigger challenge. Now, granted, we'll be using it to counteract these bad actors as well. But I do think it's an issue that you have to wonder about, what if all these data centers get taken down or hacked into? I mean, how much of our information is out there to be stolen? There's a lot of things here that because it's the dawn of the AI era, we are not factoring in fully yet the negatives. We only want to look at the positives. Oh, it's going to be great. We'll have robots doing our laundry, all these things. But in essence, there's going to be a lot of negatives as well. And I do think the markets are overlooking a lot of those risks.
What is the number one risk that the market is overlooking right now?
I think for me, this is the private credit issue, right? I mean, if you turn on the TV, you're not hearing about that. It's very rare. Maybe there's an article here, there's an article there. We hear about Blue Owl, etc. But what are we looking at? We're looking at war pictures, bombs with Iran and the Straits of Hormuz. It's taking the focus off this private credit issue, much like we saw in 2008, by the way, when oil was at 140 to 150. People, again, were not looking at what was going on, except for a few individuals, as we know from the past stories in the movies. They were looking at what was going on in the underbelly. And I do think people need to pay more attention to this. This is probably a much bigger issue than what's going on with oil prices.
Okay. And your asymmetrical trade to the upside short term, you said was Bitcoin. Do you have an asymmetrical trade to the upside with a longer outlook?
Oh man, that's a tough one. Again, for me, it's too hard to know when I have this bearish outlook on the markets. I would, again, if I had to be long certain stocks, and I am, Conagra, Kraft Heinz, and they're not fun, they're not sexy, right? But sometimes preservation of capital so that I can deploy that capital at massive discounts on assets, a la gold, silver, Bitcoin down when it goes, let's say, sub 50, and even the stock market, that's actually the best thing. And sometimes, again, having cash on hand is the best thing.
So how would investors then protect against a potential private credit contagion issue?
Yeah,
You're
I think
watching this video, you're going, okay, what can I do about it?
Yeah, and I think people have to just realize is that you don't have to be, first of all, you shouldn't be leveraged in the market, right? There's a big push to let me try to make as much money as I can. So I'm going to use leverage. I'm going to use margin. I think number one, I don't do that right now. I'm keeping it very conservative, but I'm also sitting on a fair amount of cash, right? Sure, I'll trade short term, but for me, it's waiting for the opportunity. One of the best things an investor can do is be patient and disciplined. And when something does collapse, that's a good quality asset, a la gold or silver or Bitcoin or something else, then you have the capital to deploy. In my younger years, I was in scenarios where I'd be so over leveraged and then something would collapse and I'd be like, oh no, I have no money to deploy. What do I do? And I missed the opportunity. And so again, while it's not fun, sometimes I've got money sitting in a high yield savings account just waiting right now. And I'm glad to have it there making money. At least it's offsetting inflation right now to be deployed when the right price is hit.
You sound like Warren Buffett right now, Garreth Soloway. Dry powder ready to deploy. Okay, point of highest conviction, Gareth.
I would go back to Bitcoin. I'm really liking that. Again, I've been buying Bitcoin now in the 70s and the 60,000 range here over the last couple months, just accumulating. I wouldn't call myself a Michael Saylor with that type of Bitcoin, but certainly I'm allocating it within my portfolio. And then really on the other side of the coin, I'm generally short the markets. I even have a short on oil right now that I picked up today for a play next week to the downside. Even if we go up a little on Monday, I'm not so concerned. I'll dollar cost average that position, but I'm looking for a bigger rollover back to the 70s.
Gareth, I always appreciate you taking a position, sharing your analysis, sharing your insight, and willing to take all the comments that come your way. A lot of positive comments, often a lot of negative comments, but
Okay.
I appreciate that you put yourself out there and you share your hard work, your analysis, and your insights with our viewers. Where can our viewers learn more about you and the services that you offer?
Yeah, and thank you, Michelle, for having me. And listen, when it comes down to it, I'm just telling you guys what I'm doing. If I'm putting money there, I'll just talk about why I'm doing it, and that's the questions that you're asking, and I'm giving answers. But if people want to find more, verifiedinvesting.com is where it's at. It's all charts, and really what we say is no BS, meaning that I focus on the charts and I trade based on probability, based on chart patterns. That's where I position my money. I teach people how to do that at verifiedinvesting.com.
And you also have a service where you send people trading alerts so that they can copy your trades that you sometimes, as I say, change on a very rapid basis, correct?
That's right. And we show a live portfolio too. So a live portfolio, I put $1 million in there. Every time I make a trade, if I'm buying or shorting 500 shares, 1,000 shares, all members get basically an instantaneous notification. If they want to take it with me, they're more than welcome, but they see full transparency. And that's also on verifiedinvesting.com.
How's that portfolio doing right now?
Up 17% so far this year. So pretty good. I'm aiming for 20% by quarter end. If we can do that, I'll even, next time I come on, remind me, I'll show you the live portfolio.
Okay, up 17% year to date on your life portfolio. Gareth, thank you so much. We'll catch up again soon. Appreciate it as always. Thank you.
Thank you, Michelle.
And as always, thank you for watching. If you enjoy our content, find it informative, interesting, entertaining, educational, all of the above, which we hope you do, please share it with friends and family. And if you haven't already, please make sure to subscribe. If you would like to learn more about building a precious metal strategy, you can reach out to info@milesfranklin.com. We have a team of specialized advisors and brokers that can guide you. And if you mention my name, they will give you an extra special deal. Also, make sure to check out our website at milesfranklin.com. As always, leave us your comments. Feel free to praise, whine, or just opine. We read them, and we often get some question and topic ideas from those comments, so please make sure to leave them. Thank you again for watching. For me, Michelle Makori, and the rest of the team, we will see you next time. Until then, stay sovereign.
This is The Real Story with Michelle Makori.